Good afternoon, ladies and gentlemen. Welcome back to the 7th of April weekly market review. Today, joining us is Mr. Gerald Wong, who is also observing the pullback in the markets with us. How are you, Gerald?
Hi, Sunny. Hi, good afternoon, everyone who has joined us today. Like Sunny mentioned, we are observing the markets very closely because in the past week, we have seen a lot of volatility after US President Donald Trump announced sweeping tariffs around some of his key trading partners.
Yes, and also there's a lot of re-rating among the analysts and economists, and even the Singapore GDP is likely going to be revised going forward towards the end of the year. So even some of the projections that Goldman Sachs makes on some of the major US indices has also been adjusted twice in the month of March, and I believe there will be more adjustment coming up with some of the retaliatory actions of the countries that will be doing against the Trump reciprocal tariffs. So I think we are in a very risk-off environment now, and we have to go very defensively. Some of the names on my mind that we spoke about with Gerald earlier on are the utilities and the telco names. So Singtel actually came up on our top of our minds. So I think Gerald will cover Singtel also on top of the TA that I covered on Singtel this week as well. So I think I will not uh hold back much more time. I'll let Gerald take you through what he has to share with you today.
Thank you, Sunny. The usual disclaimers, today's sharing is for information purposes only and is not a solicitation to be buying or selling any securities. If you find the weekly market review helpful, do leave us a review on Google by scanning this QR code. And if you would like to join SIAS as a member to access various online resources and investor education programs, can scan this QR code or go to the website sias.org.sg/membership. Okay, so what we saw in the markets would be a fall with the S&P 500 and Nasdaq down by close to 10%. The STI did relatively better, but still down about 4% for the week. So what actually happened was the sweeping tariffs announced by US President Donald Trump. This table would probably be familiar for some of you who have been following the markets closely. So we see a base 10% tariff across most countries. And then at the same time, for those that are seen to be having some existing form of tariffs charged to the USA, we see a higher level of reciprocal tariffs being announced. So, for example, China here, 34% tariff on top of the existing 20%. Vietnam, 46%. Europe, 20%. So those are effectively some of the key tariffs that have been announced and leading to concerns around how that can potentially impact the global economy. So I think in my point of view, it really comes down to two key things. One is a potentially higher inflation as well as a slowdown in economic growth. So, one of the key indicators that the US Federal Reserve actually tracks for inflation is this PCE price index data. And what we see here is that even prior to the announcement of the tariffs, we are seeing that the inflation is not able to go down very significantly. The February data was at 2.8%, and that is still some way away from what the Fed's target is, which is 2%. Okay, so with the tariffs that are announced, that can potentially bring up the inflation higher. And that's what the Federal Reserve Chairman, Jerome Powell, actually said in the comments last weekend, which is that the tariffs will likely lead to a higher level of inflation. Okay, even without the actual data coming in, we are already seeing that consumers in the US have a higher level of inflation expectations. So if you're to look at this chart here, over the past few months, consumers in the US have increased their expectations of inflation fairly significantly, such that in March it was actually at 5%. All of it is driving a weakening in the consumer sentiment. Okay, so this actually shows the conference board consumer sentiment, and if it's look at the expectations index, that actually reflects their expectations on income, on the state of the economy, and we have seen a very sharp deterioration in the last few months because of the tariff uncertainty. So that is driving concerns about whether, with weaker consumer sentiment, it will pull down the US economy. And already we have seen various banks lowering their expectations of US growth, as well as raising the likelihood of a recession. So with this, we are seeing a flight to safety. Bonds are typically seen as a safer place compared to equities. And as investors buy the bond yields have fallen sharply both in the US and in Singapore. So if I were to look at the Singapore government bond yield, this is the 10-year bond yield. Last Friday, it was at about 2.5%, having fallen from about 2.8% just a few weeks ago and 3.1% earlier this year. Okay, and if I were to look at the top gainers in the STI last week, we saw that the STI was down about 3%, but a few stocks still did relatively well. Singtel up by 3%, CapitaLand Ascendas REIT and CICT both up by about 2%. In terms of the worst performers, we see a number of the cyclical stocks in here, names that are exposed to global trade, including Yangzijiang Shipbuilding, down by 8%, SETS down by 6%, Seatrium exposed to oil and gas, down by 8%, and the Singapore banks also down because of the cyclical nature of their business, DBS down by 7%, and UOB also down by 7%. The name that I'm going to talk a bit more about today is Singtel. We saw earlier that it was one of the names that actually did well in the past week despite the market sell-off. And we'll find out what is actually driving this change in the deployment of capital towards Singtel. So, for those of you who are not familiar with Singtel's businesses, even though we are aware around its very strong presence in the Singapore market, but what many of us may not be aware of would be its exposure towards some of the regional telcos as well. Okay, so through its various holdings, it's got exposure towards Telkomsel, which is the number one player in Indonesia, AIS, which is the number two player in Thailand, Optus, which is the number two player in Australia, and Bharti Airtel, which is the number two player in India. So with that, actually 76% of Singtel's FY24 underlying profit is derived from its overseas operations. So what is driving this stronger performance by Singtel? Earlier we saw that they've announced a strategic plan through FY27, and part of this entails lifting the business performance as well as more active capital management. So as part of the targets to be lifting the business performance, the company is looking at FY25 EBIT growth of low double digits, and for the return on invested capital to reach low double digits levels. As part of the active capital management, they have also announced some plans to be distributing dividends as well. Okay, so with this plan towards growth and dividend, they are looking at more sustained value realization for shareholders. So in terms of the profit announced by Singtel, we saw that the reported profit was up by 11%. This is driven partly by the strong performance that we see for Optus, which is the Australian business, as well as NCS due to some contracts that they are executing for various governments. Okay, I mentioned earlier that a big part of Singtel's profit is driven by the regional holdings. And what we see here is that the regional associates profit after tax was up by 4%, driven by India as well as Thailand. Okay, so if you were to look at the Airtel business in India, that was growing by 39%, increasing from 354 million to 492 million. Okay, if I were to look at the Thai business, AIS and InTouch, the contribution increased from 293 million to 325 million, representing an 11% increase. Part of the reason why investors are hiding in Singtel is also because of the dividends. As part of the strategy, they have announced that they pay out a core dividend representing between 70 to 90% of the underlying net profit after tax, and a value realization dividend representing 3 to 6 cents per share annually. Okay, so if I were to look at the ordinary dividends declared, what we see here is that it has increased over the past few years. So looking at FY24 as an example, we see here that the interim dividend was at 5.2 cents, core dividend of 6 cents, and a value realization dividend of 3.8 cents. So that would bring the total dividend to 15 cents in FY24. For 2025, we are already seeing an increase in the interim dividend, representing a 5.6 cents core dividend and a value realization dividend of 1.4 cents. Okay, so that is actually higher compared to the previous year. If we were to look at where Singtel is and tracking against its target, if we were to look at the EBIT growth rate by 9 months FY25, that was up by 20% compared to the previous year, and that will bring it on track to meeting the target of high teens to low 20s EBIT growth rate. Okay. If you were to look at the cost savings, they're targeting about 200 million of cost savings from Singtel Singapore and Optus, and the company believes it is on track to be able to meet that. In terms of the regional associates dividends, it is targeting 1.3 billion in the current fiscal year, and in the 9 months, it is already at 1.1 billion. So once again, on track to be meeting this target. So overall, it is targeting to pay out a FY25 total ordinary dividend of around 16.5 cents. Okay, so with the dividend support, that is likely to be something that investors will watch closely for as to whether Singtel will continue to be defensive in the current market. Okay, in terms of what I'm looking out for this week, we saw DBS going ex-div today. So that's also contributing to the sharp decline that we see for DBS's share price today. We are also looking for the US CPI data coming out this Thursday, as well as various economic data from the US, including the University of Michigan consumer sentiment data. We also have the US bank starting to report this Friday, and that will be a barometer of the strength of the US economy. Okay, so with that, I'll hand over to Sunny, who will share more about the technical analysis.
Okay, thanks, Gerald, for that sharing. Let me take you through some of the major indices on this Monday morning. You can see that the STI index is down about 7%. Even the REITs index is down about 5%. Hong Kong indices, Hong Kong markets are down around 10%. So some of them are coining this as the Black Monday that we are observing right now. Okay, so on the STI index last Friday, we saw a 2.95% drop, close to a 3% drop. We lost about 116 points on Friday itself. And this is observed as the worst one-day drop since the August of last year, which is where we experienced the Japanese yen sort of a concerns. Okay, so now where are we heading? We have actually broke through all the moving averages, including the 200 days moving average on the STI index. We are now testing the low that we observed in November last year. So around this 3,500 points level, that is the current support level that we are looking at, referencing the low in November last year. On the indicator side, you can see that MACD has definitely gone into a very negative reading. That means that the negative momentum right now, the downward momentum right now, it's very strong. And the RSI has also dived down to the oversold level below the 30-point mark. So we are now seeing a very sort of detrimental kind of technical readings on the charts right now. And I would also advise, I cannot advise, but I would also say my personal opinion is not necessary you need to jump in right now because all the technicals are seeing oversold level. We would preferably want to get some indication that is there a bottom coming in already, or is there any first sign of a rebound before considering entry into the market. As of right now, like I shared earlier, there's a lot of re-rating, including what some of our ministers say that it could impact some of our GDP, and the forecast might be adjusted soon. So these are all the data that we need to keep a lookout for. So given that if it's 3,005 is were to hold, the next resistance level, of course, the long-term moving average at 3,650 points, the 200 days moving average will come in as the first resistance level, followed by the 100 days moving average at 3,008. So I think for now, the range that we are looking at is definitely around the 3,005 to hold. And then after that, we hopefully this will give us a range bound kind of a setting going forward to wait out the tariff negotiation between the countries, and that could hold the STI around the 3,005 to 3,600 level. Okay. Then next, let me move to the US indices. The Dow Jones Index, which is the 30 stocks index, you can see that it also dropped massively on Friday as well. It dropped 5.5%, and this is the biggest decline we have observed since June of 2020, and that is where we experienced the COVID-19 pandemic panic. So this 5.5% drop, you can see, also breached a lot of a technical levels as well, including all the moving averages, including the lower bound of the Bollinger Band at 39,800. We are now at 38,300 already. So MACD indicator, very negative. So negative momentum is present right now in the index. And then on the RSI, you can also see that it has also breached below the 30-point oversold level and now reading at 23. Okay. So same thing here. I think we should not rush to get in, given that even though we see that oversold signal in the technical indicators, we need to be patient and look out for signs of bottoming out. We need to look out for signs of any sign of early rebounds before considering getting in on this sort of a catching the knife situation. Okay. So the support level for the Dow Jones Industrial Index, we are now testing the low that we observed last year around the August period. That is the 38,700. If that fails to hold, then we will move back to the May and June period of last year, which is the level of around 38,039 points, or what we call the 38,000 handle. Okay, so this handle proved to be quite a significant support level, as you can see here in the early half of last year. It has been tested quite a few times and then rebounded, and that is the level that we are hoping that the Dow Jones will be able to hold. If we have failed to hold this level, then we would need to go back much more further. Okay, let me put it. Okay, the next support level could then be a multi-year high that we've observed previously in 2021, and that could have a change in polarity. Okay, but then I think the near term, let's observe from a week-to-week basis of what is likely going to happen to the major indices, and the Dow Jones Index will likely look at the 38,000 level to hold on to right now. Okay. Next, let me move to the S&P 500, which dropped about close to 6%, okay, last Friday. And not too long ago, somewhere in February, 19th of February, we just saw the all-time high of the S&P 500. From that all-time high, if you draw the top to the low that we observed on Friday, it is a massive 17% drop, okay? So this is the biggest one-day decline for the 6% drop on Friday. Is actually, you can compare it all the way back to March 2020 as well. And that is also where we experienced the COVID pandemic, okay? And this is also the the first time that we see a concept, not say the first time, but I believe there is only a few times in history, I think three times where we draw back to World War II, that we have a more than 10% drop for two consecutive trading days. Some of the scenario I can remember was the Great Financial Crisis in 2008, and of course the COVID period as well. And then the other one was the Black Monday in 1987. Okay, that's what I read in my textbook where my professors tell me in universities as well. So the magnitude of the drop last week is actually compared to those kind of a big drastic decline that we saw in history, and we are observing how it will perform. What has happened in past, and then where we can draw some reference of where to see where the rebound might come in. Okay, the S&P 500, like I spoke with Gerald earlier, we are now at the 5,000 handle. We closed at 5,074 points last Friday. And then the next level would then be the April low that we saw last year, and that would be around the 4,900 level, where we saw a rebound and a rally from the S&P 500 index all the way to the end of 2024. So 4,900 will be the support level that we are looking at for the S&P 500. Indicator-wise, I think it is all the indices are speaking the same thing. Negative momentum on the MACD and looking at a continuation of the downtrend. There is no sign that the MACD line is going to tick back upwards very soon. And the RSI also below the 30-point oversold level, with also no sign of a rebounding yet. So I think we need to hold off. If you like to get back into the market, I think you need to hold that off for a while until we see some kind of a positive reaction that the tide is turning on on technical indicators. Lastly, this is the worst performer, the Nasdaq Composite Index, which dropped 5.82% on Friday, and also dropped by a similar 5.97 decline on Thursday as well. So if you combine these two, I think it's definitely a more than 10% drop, like what Gerald tallied earlier for the weekly performance. And if we draw the drop from the high, right, that is where we observe the high in December for the Nasdaq Composite Index, and I need to adjust this reading lower. You can see that the Nasdaq Composite Index has already dropped 22% from its peak in December, and that confirms that the Nasdaq Composite Index has gone into a bear market territory. Okay, so this is the scenario we are in now, and with a lot of the tech companies actually selling to China, a lot of a trade with China, the reciprocal tariff will definitely impact the Nasdaq Composite Index more rather than the other of the two US indices, which is slightly more defensive in nature. Okay, so where could be the next support level for the Nasdaq Composite Index? I think I need to pull back, okay, quite a bit. Okay, so around this level over here, 15,100 points, you can see that this is where, okay, let me put the arrow over here. This is where we seen some kind of very credible rebound somewhere in April of last year, and the Nasdaq Composite Index actually rallied. So we believe that the Nasdaq Composite Index slightly will still pull back at least another 500 points to 15,100 or even the 15,000 handle before any kind of a rebound will come in. So there will be more, it will still get bad before it's going to get better, like going to get worse before it's going to get better. Okay, MACD indicator negative, so no need to say negative momentum will bring the index down further. RSI, although it's in the oversold territory, no sign of a rebound yet, so go off to any of sort of a re-entry actions if you are thinking of getting back to the Nasdaq Composite Index. Okay, so these are the sharings that I have today. Any more notable advice, Gerald, in this environment that we are in now?
I think what is certain is the continued volatility with the uncertainty towards the trade policy of the US, as well as what then this means for global growth as well as inflation. So that's definitely something that we'll be watching out very closely for. At the same time, we are going to the earnings season in the US, so there's additional layer of data to be tracking. So to be able to stay informed about the market, do continue to join our weekly market review.
Yes, so do remember to stay tuned to our next weekly market review every Monday. And next Monday, we will bring you more updates on what is happening on the markets. We have some of the big banks reporting end of this week, and that could also give us a sort of an insights into where some of the top minds in the financial industry are looking forward towards how the market move in the next few quarters. Okay. And I think this is the time that we have for today. We thank you for joining us and look forward to seeing you on the next weekly market review. Okay. Goodbye and have a safe trading week ahead.